Welcome to the Power and Market Report. I'm Albert Liu. I'm pleased to be joined right now by a friend, a mentor, and most recently an employer. He's the CEO of Sprott US Holdings. Whenever he comes on the show, he owns the show. Now he literally owns the show. Of course, I'm talking about Rick Rule, and he joins me now from Vancouver. Rick, thanks for joining the Power and Market Report. Thanks for letting me host your show.
A pleasure, Albert. One correction. You and I are both employees. The shareholders own the show. But other than that, thank you.
Very welcome. I have a very good reason to initiate this interview today. It's not often that we have such a nice opportunity that's relevant and in front of us. And what I'm talking about is what's going on with the VanEck Vectors Junior Gold Miners ETF. We've discussed it off camera, so I thought we should discuss it on camera. VanEck runs a very popular junior miners ETF, ticker symbol GDXJ. They're going into a rebalancing later on in June, which in itself is not unusual, but the circumstances surrounding this one are. So can you set the stage for our viewers?
I can, and thank you for giving me the opportunity to talk to our audience about this. In sum, the GDXJ, the Junior Gold Miners ETF, sponsored, as you say, by VanEck, has been one of the most amazingly successful financial products, exchange-traded funds, ever launched. It has been so successful that really it's getting in its own way. In every other ETF, in every other sector I'm available with, the market, the sector itself drives the ETF, the index. In the case of the GDXJ, the asset size has become so large relative to the underlying sector that the fund drives the sector rather than the other way around. The correct metaphor is that the tail is wagging the dog. And this has had a number of consequences. One consequence has been, particularly given the fact that the GDXJ itself is largely owned and funded by feeder ETFs, double long and triple long ETFs, the fact that it's a quantitative machine and really drives the underlying market, one effect has been that it makes the underlying market even more volatile than it otherwise would have been. It took the most volatile sector in the world and it increased the volatility. The second thing that's happened has been that there has been an extraordinary difference in market performance, market capitalization, and share price between the companies that are included in the index and those that aren't. Obviously, if you have 60 or 80 companies out of a 1,500 company universe that are included in a fund that drives the whole sector, the stocks that are included in this fund get more buying than stocks that aren't included in the fund. So you get these incredible discrepancies in market capitalization between companies that are included and companies that are excluded. Finally, because of internal controls in the ETF, where the ETF itself is constrained as to what percentage ownership it can have in the companies that are its constituents, the very size and success of the ETF has meant that it's had to go up market into larger capitalization names and more liquid names, to the point we believe that the median market cap in the fund will be in the $3.8 billion range. Our own definition of junior is below $2 billion and preferably below $1 billion. So the fund has become so successful that it's driven the sector. It's also become so successful that it has literally outgrown the sector. The circumstance in front of us that we think is particularly attractive is that the companies that are going to be reduced in the fund, the smaller market capitalization companies in the fund, we think are being sold off for reasons that have absolutely nothing to do with corporate quality. There are 4 or 5 companies that have come off in price by 25 or 30%, we think merely as a consequence of the fact that they are being reduced in the rebalancing of the fund. And they aren't being reduced because there's anything wrong with the company. They're being reduced because with their market capitalizations at $1.5 billion or $2 billion, they are too small to take on the kind of capital that is coursing through the fund. The second opportunity is, and we alluded to this earlier, the extraordinary difference in the flow of funds and the market capitalization of companies included in the fund and excluded from the fund means that the companies that are included in the fund have a lower cost of capital, a higher share price. And we think that they will have to use that higher share price to acquire smaller companies in the sector that don't have the benefit of the fund inflow. So we see two opportunities. High-quality companies that are in the index but are being reduced in the index and are subject to selling for no reason that has to do with fundamentals. And also looking at the larger companies in the index that are enjoying a cheap cost of capital and trying to figure out which companies that aren't in the index are strategic fits for them for takeovers. We are expecting in the next 18 months, if the valuation arbitrage doesn't change, 5 or 6 or 7 takeovers at 30 or 40 or maybe even 50% premiums depending on the market. This is a circumstance that we find particularly attractive.
Rick, I can just sense the viewers stopping and replaying that last bit probably 4 or 5 times. So basically, like you said, the tail wagging the dog, or as the way I look at it, the tail is so big it's shopping for a new dog. My notes say since 2014, the market cap threshold has increased from 448 million to near 3 billion. Up to 60% of the index may change, is what I read. And the other thing that may be pushing this is that GDXJ was running into regulatory problems by owning too much of these companies. So they're going to broaden the scope of the index. So dog is shopping for a new, tail is shopping for a new dog. And if you were interested in the dog and not the tail, then this is probably not good for you.
I think that's accurate. People who are using that ETF as an excuse to buy the market probably don't understand that what they're buying is a set of companies that really aren't representative of the junior market at all. That's a whole different story. For them, of course, we'd love to have a discussion about the Sprott Junior Miners Index, which is a much smaller market cap index. But the subject of today's conversation really is the arbitrage opportunities. Albert, you'll recall that the gold stocks did extraordinarily well in 2016, which they often do in the first year of a bull market. Reminded me sort of 2001, a very nice up move, followed, as they almost always are, by what I call a digestion period, meaning that the market came off even though the gold price was strong. We have anticipated that we would have good buying opportunities this summer during the normal summer market doldrums. But these doldrums are being accelerated by the market action, the disintermediation from the GDXJ. In other words, the normal doldrums have been exacerbated by the turmoil in the market engendered by the rebalancing of the GDXJ. On top of these two opportunities, the fact that you are going to have very large arbitrage opportunities, that will benefit detailed due diligence, trying to figure out which companies are truly strategic to the companies that will be the beneficiaries of larger fund flows from the ETF, makes what is, from my point of view, a particularly compelling opportunity for people who want to be involved in the smaller end of the gold equity market.
So this it sounds to me like a two-step process. So first you have the sort of transparent and predictable process of the index reconfiguring itself and then rebalancing, the fund rebalancing to the index. It should be, I guess, not so difficult for the market to predict where prices would go based on the changes in the capital threshold and whatnot. Has that been fully priced in?
It has not been fully priced in, although you have begun to see definite bifurcation in the market capitalizations of companies below $3.5 billion and above $4.5 billion. In other words, there has been substantial anticipation. But I suspect that the turmoil involved in the rebalancing, remember that they don't have to rebalance in one day. I suspect that the turmoil involved in rebalancing will continue probably until mid-July. And there's nothing that the market hates more than turmoil it doesn't understand. People who are index buyers, not stock buyers, certainly don't understand turmoil. Another thing that's really interesting about this that I think we need to think about is, we talked before about the fact that, almost 50% or sometimes more than 50% of the assets under management of the GDXJ come into it through double long and triple long feeder funds. And we understand that the average holding period of the feeder funds, the Nugget and the Dust, is about 2 days, which is one way of saying that a lot of the action that we're seeing is quant trading action. It has nothing to do with anything other than buying the volatility inherent in the junior gold sector. And this has some manifestations too. Some of the money that used to chase the leverage inherent in individual junior mining shares is now expressed in buying volatility in the double long and triple long ETFs. What that means is that the market is beginning to be increasingly quant-driven. And if you're an investor who invests in fundamentals, you have less and less competition. A machine can kill you in terms of understanding the quants, but the machines can't do qualitative analysis. All they can do is program an algorithm to look for what qualitative people can buy. This is truly a unique opportunity. Individual stocks that were already underloved are becoming completely unloved. The catalyst, as I say, for them being loved is understanding from a qualitative viewpoint what makes them attractive to the very few stocks that will be favored by the flow of funds over the next 12 months.
It's funny, Rick, the idea of layering leverage on top of junior mining stocks to me sounds like putting sugar on a donut. But I guess speculators will be speculators, and it's a useful tool for them.
Well, Albert, you want to hear something more strange? Some of my friends in the brokerage community tell me that most of the retail buyers of the double long and triple long ETFs do it on margin.
That's good. That's great. Okay, let's talk about the second step, the really good opportunity, I think, that you alluded to. So this is essentially the acquisition, merger acquisition risk arbitrage. What's interesting about this to me is this is a very specific and highly focused opportunity. It's not something like, for example, a situation where a bull market in general in stocks, or low interest rates in general, or loose lending standards in general reduces the cost of capital for big companies. This is an index rebalancing that's causing this. This event only appears in the junior mining sector. It only appears right now.
That's correct. What I would consider this to be is a catalyst. I, and I think yourself, and I think most of our customers, already believe in the gold thesis. And we already believe in the junior gold sector, or else we wouldn't be having this discussion. We can point to the fact that although the gold price has done well this year, gold equities have done poorly. And we can point to the fact that in a historical context, this explanation for the gold stocks doing poorly in the context of the run-up that they had last year is easy to explain. Also, if past is prologue, we can point to other periods where the gold price has outperformed the gold equities, and in each situation that I can remember, the gold equities played catch-up. So all of that was already in place. The thing that's changed is a catalyst for individual transactions that is artificial. It has everything to do with flow of funds and cost of capital. So the strategy here will be to look at the companies that have been beneficiaries of the flow of funds with the ETFs and try and figure out which other companies in the big universe of listings that were excluded from the ETF have strategic benefit to the companies that are getting these artificial funds flows, buying them on a qualitative basis in a way that we can outcompete the computers, and then just wait for nature to take its course.
How long is it reasonable to expect this to play out? How much time?
My suspicion is that we'll have at least 18 months before this game is done. But my belief is also that as a consequence of the incredible deltas that we're seeing between market capitalizations and cost of capital, that the game, if you will, the process that we're talking about will begin this summer.
Okay.
In other words, I think that the opportunity is immediate, but I also think that the opportunity will play itself out over 18 months.
When you get into this sort of inverted situation where the money is chasing the opportunity rather than the other way around, do you get concerned? And I guess you may have answered this already, that all of the fundamentals already look good to us, which is why this shouldn't be of a concern. But I always pause when I see something like this, money chasing opportunities.
I think the answer to that question is that markets are often inefficient. I think that the money that you see in this particular instance, that is the money from the ETF, isn't chasing opportunity so much as volatility. People are buying, particularly the underlying leveraged ETFs, really buying two-day trades on volatility. I think the people who are buying stock in companies for qualitative, not quantitative reasons, are the people probably who are chasing the opportunity. And we are competing against people who are really chasing volatility. And I think that's an unfair fight, with the advantage being ours.
Right. The other thing they may be chasing is momentum too, because there has been a lot of momentum in these stocks. Is that correct?
Well, the momentum recently has been negative. Certainly the momentum through 2016 was very, very positive.
Okay. Now, do you think that, I guess, sort of the broader lesson in all of this, with this ETF being so popular, that this is going to result in more miners if the capital is chasing this sector? I think
it'll evolve very differently. I think it'll evolve in the near term to fewer miners. One of the things that's happening as a consequence of the fact that the sector is coming to be dominated by the ETF is that companies not included in the ETF are having a much harder time finding capital. And this concentration of capital is favoring the few, not the many. The second consequence of this is that the smaller speculators who may not want to be in the overall ETF are in the feeder or volatility ETFs rather than being in individual small stocks. The third function that we see here, if we're right, is that the sort of 15 or so beneficiaries of rebalancing will probably acquire 15 or 20 other companies. So I think the logical outcome of the circumstances that we're seeing in the market is for fewer rather than more listings, because the money isn't coming into the junior market as a market per se. As we've talked about, it's coming into a small number of listings that increasingly are so large that they're not actually even junior stocks.
Very interesting. Okay, let's conclude that discussion there, Rick. I can't let you go without asking you about our conference in July. So can you talk to the viewers a little bit about what's going on at the Natural Resource Symposium?
I can. We're having a great range of headline speakers. One of the interesting things that changed very recently is my own decision to devote one of my workshops to the GDXJ rebalancing and the opportunity that's in front of us as a consequence of this. You have to be fresh and topical and opportunistic in the conference, and I intend to do just that. But we will also, of course, have backed by popular demand James Rickards, who knows as much as anybody alive about the nature of the financial structure of the financial services business. You'll remember that he was general counsel for long-term capital management, which just about took down the system when it blew up. I'm also delighted to say that because of our last year's attendees have requested it, we're going to have David Stockman, Director of the Office of Management and Budget during the Reagan years, talk about the politics of the economy and the probability that Trump can win any of the fights that he's attempting to win, as an example. A third speaker that I'm really excited about, I've gotten to know him fairly recently, is the ex-energy secretary of the United States in the Bush years, Spencer Abraham, who will talk about the politics of energy and energy investing in the United States and Canada. I'm really excited to have Spencer with us. We will, of course, have many of the popular gurus, the newsletter writers in the natural resource space and the general space, people like Doug Casey, Eric Fry, Marin Katusa, Matt Battiali, all of our friends from the editor side. But importantly, beyond the gurus, one of the most popular features, perhaps the most popular feature of our conference, will be the fact that we're going to have many serially successful mining entrepreneurs, people who have built mining companies, talk about the things that they have done to build their mining companies and how the lessons that they've learned building those mining companies shape the way that they invest and shape the way that our attendees should invest too. The final thing that I think really sets our conference apart from others is that at our conference, we don't view the exhibitors as just advertisers. In almost every conference I've ever been speaking at in the last 35 years, the conference sponsors regard the exhibitors as advertisers, meaning that to qualify for an exhibition spot, you basically needed a check that cashed. Our attendees have told us that they consider the exhibitors to be content too. The consequence of that is that every exhibitor, every public company exhibitor at the Sprott conference is owned in a Sprott-managed performance fee generating account. That doesn't mean that every stock goes up. What it does mean is that they have been vetted and they have been found to be worthy of investment of our own money. That's a critical difference between this conference and any other conference. But the final thing that sets this conference apart from any other conference is any paid attendee who doesn't believe that he or she has gotten their money's worth can get a full refund. I don't know any other conference that makes that claim.
No, absolutely. And you can find out more about that at naturalresourcesymposium.com. If you have any questions, you can get in contact with Rick and me at question@sprottmedia.com. Of course, we're both on Twitter at RealRickRule and at Albert K. Liu. Rick, I know you got to run, so we'll let it go here. Thank you very much for making time to come back on the show. Really appreciate it.
A pleasure, Albert, and thank you for facilitating this call. It's a really timely one, and it was a really fun one to do.
Yeah, I agree, and I think the viewers are going to agree. Till next time, it's Power Market Report. Take care.